I think what's going to happen in the gold space is simply greater fear. People are going to look at the arithmetic around fiat denominated instruments and they're going to be afraid. Uh, People are going to look at the probability that the Fed is going to have to lower interest rates in the face of persistently high inflation
Hmm.
and understand that the long bond is a lousy instrument. If the interest rate goes up according to markets, which is to say supply and demand of money, then the long bond absolutely gets crushed. If it doesn't, if the interest rate stays low, then what happens is the long bond gets crushed anyway, because the purchasing power of the distribution doesn't keep pace.
Yeah.
A really, truly lousy place to be. Um, if this continues, I think you'll see the gold stocks begin to bridge the gap that has occurred. In other words, gold has outperformed the gold stocks so far. This is easy to understand. The purchasers of gold have been central banks, and they don't buy gold stocks. The idea that there was no follow through, people are scratching their heads over. This is a big no brainer. There was no retail participation in the gold market, according to the statistics around the purchases and sales of ETFs, until 11 weeks ago. Now there is individual purchases of bullion in Western Europe and the United States, and traditionally these people, in addition to being bullion buyers, have been gold stock buyers. So one would expect, as the market for gold broadens and as the momentum established by the metal itself continues, that will eventually come down into the gold shares.
Before we dive into Rick Rule's alarming insights, let's look at some eye-opening facts. The probability of the Fed lowering interest rates amidst persistently high inflation is soaring, and fiat-denominated instruments are becoming riskier by the day. As Rick Rule warns, people are going to look at the arithmetic around fiat-denominated instruments, and they're going to be afraid. If interest rates go up, the long bond could get absolutely crushed, and if they stay low, the purchasing power doesn't keep pace, making it a lose-lose situation for bondholders. Central banks are buying gold, but not gold stocks, and individual purchases of bullion are rising in Western Europe and the United States. This shift in the dynamics of the gold market could signal a significant change ahead. Gold has outperformed gold stocks so far, but with retail participation in the gold market increasing, we could see a major surge in gold equities soon. What does this mean for your investments? How can you protect and grow your wealth in these uncertain times?
Wall Street is reactive, not anticipatory, I would argue, having lived on Wall Street a very long time myself. What you talk about is important, but it's also important to note that even as the gold quote has gone up, the costs associated with producing gold have gone up too, so that the margin expansion that you're looking for has been tampered. It is estimated that the social cost of producing an ounce of gold, including offsite capital expenditures by miners, taxes and royalties, have been increasing at 20% compounded. Skilled labor has been increasing. Energy has been increasing. You are going as early as this quarter to begin to see real margin expansion from the very high quality gold producers.
Mhm.
But the rest of them haven't seen much margin expansion at all, simply because costs have risen as fast as the gold price, the gold quote has. As you see margin expansion, I think you will begin to see generalist investments coming into the gold space. In fact, I think you'll see that anyway. I think you'll see an increasing number of institutional investors, particularly those that are responsible for long-term investments, endowments, pension funds, things like that,
Mhm.
go into the gold equities trade out of self-defense. Remember this, Adam, in terms of that history, in terms of the reticence with regards to how the investment community views the mining sector. Remember the poor performance of the mining sector in the decade 2000 to 2010. The market, the share prices did well in anticipation, but the operating performance was fictionally bad.
Yeah, terrible.
The gold quote increased sevenfold from 250 to 1900, and the free cash flow per share in the XAU declined. It took special skill to screw up an environment where the selling price of your product went up sevenfold. So there is skepticism around the ultimate corporate performance of the gold mining sector. It has, but it would be easy for them to be recidivist. Virtually all of the management teams that were responsible for the worst part of that performance were allowed to pursue other employment opportunities by their shareholders. Similarly, the investors who now own gold mining shares, myself included, keep their managers on a much tighter leash than we used to. Mm-hmm. Now, if the gold price increases and the gold share prices go up, then investor tolerance may return. And certainly, if investor tolerance returns, management misfeasance and malfeasance will be something that we have to contend with in the future. But I don't see that circumstance getting on our way for 2 or 3 years. Absent a global recession, I think we're in a real sweet spot here. The commodities have outpaced the companies. The companies have maintained some sense of financial discipline, but the companies are attractively priced, in particular relative to the commodity price. My experience has been that precious metals bull markets are kicked off by gold, by the fear buyer. When the momentum is established, particularly when the momentum becomes palatable to generalist investors, that is to say, the greed buyer. Silver, perhaps of its higher volatility, perhaps of its lower unit cost, takes over leadership. It moves further, it moves faster. We have seen a real move in the junior silver equities in the last 6 months, which suggests that silver might be, or the investors might be anticipating that move. Again, I think you have reversion to mean. A selection of the higher quality silver juniors 6 or 7 months ago literally could not get a bid. And maybe what you've seen in terms of the share price escalation is just that we've worn out the sellers rather than we've established buyers. But a silver bull market, a silver equities bull market, is truly, truly something to behold. I'm hoping to enjoy one more in my life. I remember well the decade of the 1970s when just one little stock, Coeur d'Alene Silver, which sadly I didn't own, went from 10 cents to $65.
My goodness.
If you move forward to the early 1990s bull market, a short bull market, 2 that I did own, Pan American Silver went from 50 cents to $40 in 6 years. The Silver Standard went from 72 cents to over $40 in 6 years. People don't understand the magnitude of these precious metals equities markets. Now, I'm not suggesting that people crowd into every silver penny dreadful on the planet. People need to understand something about what makes a silver equity work. But a silver equities bull market is a truly wonderful and strange beast. Well, energy, again, I think is a no-brainer, depending on how you define energy. You know, the big thinkers in the world have told you that the end of fossil fuel is with us. That noted energy physicist Greta Thunberg is an example. President Biden, Prime Minister Trudeau, these guys. The thing is, it isn't. Let's again examine a few facts. Alternative energy, of course, is going to be the end of fossil fuels, they say. We have now spent over the last 40 years well in excess of $5 trillion. And we have reduced the market share of fossil fuels from a high of 82% 40 years ago, all the way down to 81% today. A $5 trillion investment has reduced the market share of fossil fuels from 82% to 81%. What makes you think with any investment in any amount of money that we will enjoy, if that's the right phrase, peak oil demand in 2030? This is an absolute absurdity. Another number. The oil industry on a global basis, including prominently state-owned oil companies, is underinvesting in sustaining capital investments to the tune of $1 billion per day. In a capital-intensive business like oil and gas, if you don't invest in sustaining capital, you reduce your ability to produce. In other words, you encourage supply shortages. Supply shortages support price. The rational response to that is to look for profitable companies with good project pipelines that are making the sustaining capital investments so that they will be able to produce into upcoming supply shortages. This is so simple. You have an industry that's enjoying absolute record free cash flow. You have them competing with some brain dead morons, both public and private, who don't understand that the outlook for fossil fuels is still very bright. And you can easily segregate the companies that are making sustaining capital investments from those who don't. Investing in this theme for the 5-year time frame is as close to a no-brainer as you can get. And by the way, you don't have to wait 5 years to be right. These companies are paying wonderful dividends and buying back stock while you wait.